Welcome to Jain Brokers Company, your trusted partner in finance and market insights. Today, we're breaking down the impact of Operation Sindoor on the Indian stock market as of May 7, 2025. Let's understand how this strategic counter-terrorism action is shaping market sentiment, sectors, and investor confidence. Operation Sindoor is a high-level counter-terrorism offensive launched by Indian security forces in response to the tragic terrorist attack in Pahalgam. This operation aims to dismantle terror infrastructure in Jammu and Kashmir and send a strong geopolitical signal, both regionally and globally. While the military success of the operation has been praised, investors are now analyzing its economic and market repercussions, especially in the short and medium term. As of May 7, 2025, the Indian stock market has shown signs of heightened volatility. The Nifty 50 and Sensex both opened lower in early trade, reflecting investor caution. The India VIX, or Volatility Index, spiked nearly 12%, indicating fear-driven trading behavior. Foreign institutional investors, or FIIs, have turned net sellers, withdrawing approximately 2,800 crore rupees over the past two sessions. However, the broader fall has been contained, showing the underlying strength of the Indian economy and resilience among domestic investors. Let's break down the sectors most affected. Negative impact: travel, tourism, and aviation. Stocks like Indigo and IRCTC fell 3 to 5% due to expected decline in tourism in North India. Hospitality hotel chains with operations in Jammu and Kashmir, such as Indian Hotels and Lemon Tree, are under pressure. Insurance companies with exposure to the region are witnessing increased claims speculation. Positive or defensive moves: defense and aerospace. Companies like HAL, Bharat Dynamics, and Bell surged on expectations of increased government spending. Pharma and FMCG. These remain largely stable as investors rotate into defensive stocks. IET and tech, largely unaffected due to their global revenue streams. While the geopolitical risk is real, it's important to note that India's macro fundamentals remain strong. GDP projections remain unchanged at 6.9% for FY26. RBI monetary policy is expected to stay neutral unless oil prices are significantly impacted. The rupee saw slight depreciation against the dollar, hovering around 84.50 rupees per USD due to safe haven demand. If Operation Sindoor remains limited in scope and duration, the market is expected to recover quickly. However, any prolonged conflict or escalation could lead to a broader correction. Here's a realistic range of scenarios. Mild impact, which is likely, could see a 2 to 3% dip in indices over the next week with a quick recovery if peace is restored. Moderate impact might result in a 5 to 7% decline if tensions spill over, or if FIIs remain net sellers. Severe impact, although unlikely but possible, could lead to a 10% or more correction if there is a cross-border escalation or international sanctions risk. However, the Indian market has historically recovered from geopolitical shocks faster than most emerging markets. What should investors do? Stay calm and avoid panic selling. Focus on fundamentally strong stocks in banking, IT, FMCG, and energy. Consider defensive sectors and gold ETFs as a hedge. For long-term investors, such dips present opportunities for value buying. At Jain Brokers Company, we advise investors to focus on discipline and data, not noise. Our research desk is closely monitoring developments, and we're here to guide you every step of the way. Thanks for watching. For daily insights, sector-wise updates, and personalized investment strategies, subscribe to Jain Brokers Company and click the bell icon. If you have questions or want expert portfolio guidance, reach out to us at +91 7703821656 or jainbrokers.co@zoamail.in. Stay informed, stay empowered.